heard the story about the borrower and the lender? If I owe you $100 and I fall on hard times, I've got a little problem. But if I owe you $1 million, now you've got a problem, a big problem. And that's the situation many lenders are in today when it comes to commercial real estate loans, specifically loans to buy office buildings. Today, you're going to hear from two of CBRE's top members of their capital markets group. Brad Zampa and Russ Ingram arrange for the financing and sale of office buildings in the tens or even hundreds of millions of dollars. We're going to talk about the significant challenges faced by owners and lenders of office buildings and how big of a problem this might be for the broader economy. Brad, Russ, thanks so much for joining me. I really appreciate you taking some time. I just want to make sure everyone understands sort of what you do. I mean, CBRE, huge real estate firm, but you guys are in the capital markets group. If I understand right, you arrange for financing for some of the largest office properties really in the country. Is that correct?
Yeah, that's correct. We raise capital, mostly debt capital. Some of it looks like equity sometimes, but for office buildings, focused primarily on Seattle, San Francisco, Oakland, San Jose, Los Angeles, San Diego, and a little bit in Denver. And I'm also helping Russ out with some deals in Texas.
And my focus is a little bit different. Brad's got the easy part. I've got the hard part. I actually sell buildings, so sell office buildings. I'm based in Texas now, so I cover Texas and surrounding states. But previously, I was based in San Francisco, worked on the West Coast.
Between the two of you cover probably 66% of the country in some fashion.
We see a lot of it, yeah, on the office.
Yeah. Okay. Yeah. So that's really why I wanted to speak with you. What are you seeing? What does it look like out there, specifically in office? Yeah, everyone knows the story, right? Post-pandemic, nobody wants to go back to their office. People are being dragged back begrudgingly. At the same time, you've got employers that want to shrink their footprint because they're not having people in 5 days a week. So there's some efficiency there. How big of an issue is it really? What are you seeing on the ground?
I'm seeing a big bifurcation in the market where trophy office buildings are performing extremely well. Rents are still going up because the tenant base has shrunk, but they're all chasing the same buildings that are amenitized, great locations, walkable retail. These aren't your dad's, your grandfather's office buildings anymore. ESG is playing a big part in it as well. So you'll take a building like Salesforce Tower on a given Tuesday is full, and you go 2 blocks away and you go, I won't pick on any building, but you can go to a building and it's maybe 30% occupied. So I think as these leases roll, tenants are going to migrate to the top trophy buildings in every CBD, and that 10 to 15%, maybe 20% of the market is going to do really well, and then the rest of the market is going to hurt.
And I agree with Brad that there is a bifurcation, and I'll even take a slight step backward that when the pandemic hit, all areas of commercial real estate were impacted. Multifamily, industrial, everything was impacted. Okay. But within 3 or 4 months, they all came back. And you started seeing capital come back for it. You started seeing debt come back for it, and trading. And offices lagged behind there because, as you said, that work from home, work from anywhere. And if you were working in Salesforce Tower in 2019, chances are you live in Boise, Idaho, or Austin, Texas, or somewhere else, and you aren't going back into the office. If you worked at a warehouse facility, you're darn right you were back. As soon as you were allowed by the government. People need places to live, so multifamily was back. So all of these things conspired to make office a little bit slower of a recovery. Having said all that, leading up into the Ukraine war and inflation, it was a pretty active capital market for office. It was very aggressive debt, very aggressive equity. In fact, we were seeing price per square foot records all across the country for office heading into Q1 of 2022. Then once inflation hit, the music stopped. And the music stopped for everything, right? It wasn't just office. Industrial, it was trading in the high 2s. Now when your debt cost is 4 to 5, they can't transact. Same with multifamily. Same with office. But now, on the backside of getting a handle on inflation, I would say that investors are looking at industrial multifamily, data center, cold storage, self-storage, all these others as less risky than office. And a lot of it is the headline risk that you noted, that you got to drag employees back. There is some truth to it. I also think there's a lot of hype around it, but
Yeah.
there's no denying the Castle system data that says, on average, physical occupancy is 60% of what it was in 2019.
Wow.
And then one final point for your audience, and that is, like, CBRE over the last 7 years has been going through a right sizing of our physical occupancy, because what they found is that on any given day, Brad is traveling to New York, or I'm out meeting with clients all day. And so rather than having one-for-one desked people, they said, hey, we can have a free address system, and we can basically cut out 25% of what our needs are. So if you think about it in that context, actual physical occupancy is not that different than what it was in 2019. We're just keeping closer track of it. So if physical occupancy is 55 to 60%, and full on pre-COVID it was 75%, it's not as big of a gap as what I think the media would have you believe.
Oh, interesting. So, I mean, the way you describe it, Russ, it almost sounds like it's more of an interest rate story than the pandemic story that's hurting.
I think it's twofold. One, it's interest rates, and I've been doing this a long time, and typically when the cost of money changes, it takes 6 to 9 months for the seller to catch up. But for a full year now, the cost of money has been continually changing, and yet sellers are doing a really good job of catching up. I would say, and Brad, I don't know what your view is, I think it's less about the interest rate and more about liquidity. And I think Brad can hit on, where does the liquidity come from commercial real estate, especially for office, and then why we may be facing a little bit of a liquidity crunch.
Yes, I mean, zeroing in on office, it's virtually impossible to get a non-recourse loan right now on an office product in the CBD market. So you got 4 buckets of capital in the commercial real estate world, in the debt world. You've got CMBS, which we can touch on. You've got banks.
Let me just make sure everyone follows us, because not everyone is from the real estate world. So, but because of The Big Short, Michael Lewis's famous book and then movie, everyone I think has heard of CMBS, which is a commercial mortgage backed security.
Correct. It's a way that lenders can sell off loans off their books and stay liquid. So they're really sold off as bonds. They're turned into bonds into big pools, and they're tranched out. And there's riskiest, would be triple Bs, and the least risky would be triple As. And you can buy them pretty freely. So there's CMBS, there's life insurance companies, there's banks, both domestic, regional, international, and there's private equity debt funds. So those are your 4 buckets of capital. Life insurance companies will not bid on an office deal today unless it's probably the best building in the market, and it would probably have to be at 50% LTV or less, if you could even get a bid. The banks are out. We saw what happened with SVB and some of the regional banks. Wells Fargo's not getting paid off. They've got $140 billion worth of commercial real estate on those books. They're not getting paid off, so they're just extending everybody for the most part, just as an example. And then CMBS is really a tough execution right now, because there's no buyers for the bonds, because there's so much price discovery on value. We don't know what the buildings are worth, even if they're leased. And you don't know what it's going to lease for when the leases roll. So there's a lot of price discovery happening right now, and that causes lenders to, what I call turtle. They hide. They run for the woods, and they wait until they can figure out where values and where rents are. Nobody knows. And that's what we're going through right now, is a big period of price discovery.
Wow. Okay. So then that's really why I wanted to bring both of you into this discussion, because what I'm trying to do is take a look at what's happening in the banking sector and figure out how this factors into the Fed's plan, right? The Fed has been overt in saying we want to tighten up liquidity, which sounds nice and tidy and makes sense. Take some capital out of the economy, inflation will come down, we'll have a nice soft landing. But the reality is much more messy, right? Sure. And we've seen already 2 banks fail. The 16th largest bank in the history of the United States failed, Silicon Valley Bank, which I think might tie into some of what you have to deal with, Brad.
Yeah. That's an interest rate story too. We've never seen interest rates go up faster and higher in our lives. I mean, they went 500 basis points in 12 months. That is going to take a while to ring through the system. And that means, cost of capital is doubled, if not tripled. And then you add in work from home, and you add in what's happening in our CBDs, which is a whole nother issue. That's more socioeconomic. That's, crime, homelessness, and open drug. You have in Seattle, San Francisco, downtown LA, you have a safety issue now. So now you have a safety issue, you have a work from home, you have increased interest rates, and all that's just like a perfect storm. Offices, they're gonna feel it the hardest.
And Ed, I think there's a final point that you haven't quite covered yet, and I think the Fed has been very effective and you said taking liquidity out. I would say in killing demand, right? That's the goal is to really crush demand, so that the goal was to do this soft landing. I don't think very many people believe there's a soft landing, and I would tell you that tenants in the market, as well as commercial real estate investors, factor in the probability of a real recession, not a soft landing, a real recession. And that's another reason why people are keeping their wallets in their back pockets and not pulling it out to go buy things, is that, how silly would you look if 3 months after you bought this beautiful, shiny office building, and then we enter a recession? Why didn't you just wait until after the recession? Then you could buy it and probably buy it for cheaper. And so I think this notion that the Fed's going to be very effective at their stated goal of crushing demand, that will impact the real estate investment.
Yeah, and there is liquidity out there. I'll add to it too. I don't want to say that there's no liquidity. It's just expensive. I mean, if I go try and price an office deal today, and just to throw out a spread over an index, you'd say SOFR 550, SOFR's 600. SOFR's at 475. So you're talking about like 10 to 11% money. That is shocking to groups that are rolling off a 4.5% loan, right? Or a 5% loan. It's extremely expensive, but there's plenty of capital out there. It's just nobody wants it.
Wow. Well, is it shocking, Brad, or is it not economical? Does it swing the cost of debt to the point where the numbers don't work anymore?
Correct. 100%. Most of the deals that are getting done that I'm involved in on the West Coast are all cash buys. And the thought is, you got to be obviously a big institution or a high net worth family to buy an $80 or $100 million office building all cash, but it's happening. And then the thought is they'll put debt on it next year or the year after when the Fed ratchets it down rates again, because they will. Is it going to go down to 2% or 3%? No. But is it going to go down to 4 or 5 historically? Yeah, I think it will.
These types of situations in any economy create opportunities and also create losers, right? Let's start with the bad part first. What is the bad situation that happens from the Fed's actions? Say you bought an office building for $50 million 10 years ago, and now you've got to refinance. And maybe it's a building that's already 15 or 20 years old. So it's not what you'd call a Class A property.
Got a big problem on your hands.
Yeah.
You have to have conviction, and it's real estate's local, right? So it depends on the market. If you feel like you can turn this building into something special, and you're willing to put that money in the building, then great. But you're seeing most groups not willing to do that right now because you don't know what rents you're going to get. You have no idea how long you're going to have to carry it. So you got carry costs, and it could be 2 years, and that's not a really good investment. So a lot of groups are deciding either go rework my loan, or I'm going to give the keys back, and that's what's happening real time, like right now.
So Ed, I might give you a slightly more nuanced answer, and I'll use the example you used. That let's say you bought a building in 2012 or 2013. Your 10-year loan is coming due this year. In a place like San Francisco, your rents are 120% greater today. If you knew what rents were, they'd be double what they were in 2013. So you have some equity there, right? And then this just comes down to how much lease term do you have? What's the rollover? What's the occupancy? And if you're 60% leased, refi is going to be very, very challenged for all the reasons Brad noted. I think the harder deal is you bought a deal in 2019, so kind of towards the top of the market, and it was a value add deal. You put 3-year debt on it, 4-year debt on it. Now you're running out of debt room, and you bought it at absolute the worst time because there hadn't been that much leasing to be had during that time period. And so you have a high basis, you have a high loan amount, you haven't completed your business plan, so the income is not where it needs to be to support a refinance. But I would tell you, and Brad, you can opine on this, lender doesn't want it back. And if you've been a good borrower and you've done all the things that you were supposed to, and then the market just didn't reward you, I think you're going to get some runway from that lender to get to a better spot.
Definitely. I've probably been on the phone this today with maybe 6 or 7 different household name lenders. I'll leave off specifics, but the biggest banks in the country, in the world, quite frankly, and they are definitely extending everyone they possibly can because they don't want this stuff back. So if you're willing to write a check for somewhere between 10 and 20% of the loan amount down, you're usually able to get 2 to 3 years. But you have to be willing to write that check. And those checks are big. Sometimes they're really big. There's talking on some of these loans are 200, 300, 400 million. They're going to want you to pay it down to $50 million. And then, you have to be willing to write that check or the ability to write that check. And if you don't have the ability to write the check, there's a lot of mezzanine and preferred groups out there that are waiting. I don't want to call them, vultures, but they're looking to, make a mid to high teens return, and it's rescue capital. And so there's a lot of money out there for that, but we're not quite there yet. We call it, recapitalizations, but it's coming.
So we talked a little bit about Silicon Valley Bank. Let's dig into kind of that aspect of what we're talking about, because Silicon Valley Bank had they had a lot of issues, but if you boil it down, my understanding is they sort of failed to manage their interest rate risk, right? They failed banking 101.
It's twofold. It's twofold. Yes, and they lent on very risky assets. They
had 2 assets, right? The 2 assets that really got them in trouble, that there were their longer term investments, were U.S. bonds, government bonds, and CMBS, Commercial Mortgage Backed Securities. What kind of a problem do you think this is for a bank? The example that you just gave, where the bank says you need to pay down your note, and then we'll give you an extension.
I think it's really a mark-to-market issue. If you don't have to take the mark, you're going to push it. You can kick it down the road. But they had liquidity issues, so they had to take the mark. That buried them, right? So a lot of these banks have loans. I mean, if you look at most people's home loans, I don't know what you're paying. My home loan from several years ago is at 2.5% or something crazy. If you had to sell that loan today, it's worth 50 cents on the dollar. But if you don't have to sell, you can hang on. CMBS is the same way. Most CMBS deals are cash flowing. Those aren't bridge deals. Those are cash flowing deals. So if you can hold the bonds, you're probably going to be okay. Right? But if you have to take a mark today, is where the huge losses you're going to see. And I think most of the regional banks, to tell you the truth, I'm a little more rosier on them because a lot of them take recourse for their financings, which means they have personal guarantees in place. And so a lot of these groups, whether, I don't want to name names, but I could, most the regional and local banks, they're recourse lenders. So you're on the hook personally. So they're going to be in pretty good shape if things go sideways, right? So it's a different animal.
Yeah. So, Ed, I think one of the problems with Silicon Valley Bank is that they more than doubled in size in a 3-year time period. They didn't have enough legit, traditional investments, so they plowed all that money into CMBS and treasuries. You look at the typical commercial bank, the way they structure their commercial real estate, it's all floating rate stuff. They will ask the borrower to hedge the borrower's risk. But the lender is getting a floating rate instrument. So as SOFR changes from 25 basis points to 5%, their income's going up. And so Brad's right. If you don't have to sell it, especially their commercial real estate product, they actually don't even have a mark-to-market problem on their commercial real estate. They do on their residential, where you're doing everything on a fixed rate basis. But on commercial, I think they're golden.
You mentioned SOFR a couple of times. Is SOFR the new LIBOR?
Yes. Yeah.
Okay.
About 2 years ago, transferred over to SOFR. It's about 4.65 today, I think. It's kind of bumping around. But
4.65.
Yeah.
Wow.
So your average.
And just what was it 2 years ago?
25. 0.25.
Wow. Just massive. Amazing.
That's the issue.
So, Russ, I've read in a few different places that maybe things aren't as bad as they sound, and you two are both, I think, saying the same thing. But I've also read that with office, that up to 25% of existing office space today is going to be effectively obsolete by the end of this decade. That's a lot of space, and I've heard a lot of people who aren't in real estate say, well, what a great opportunity. We can take that space and turn it into residential. And every time I brought that up with anyone in the business, I've heard a litany of reasons why that doesn't make sense. Do you agree with that? And if you do, what keeps the office to residential conversion from working?
It's a function of, on one hand, cost to convert, and on the other hand, the rents that you can generate from office as it currently sits. And so a market like Houston, you're going to see a lot more conversions. Downtown Dallas, there's 5 of them going on right now because there's very little demand for CBD Dallas office, and the rents reflect that lack of demand. And so for a CBD building, you kind of need a basis of $50, $60 a foot. For a suburban office, you really need a basis of $30 to $40 a foot. But it's also a function of what kind of rents you can get. Like in Austin, Texas, the rents never fall far enough to make conversion make sense. The building's just worth more as an office building than it is as a conversion place. So it's a function. I mean, you're putting in to convert an office building to residential plus minus $400 a square foot. Right. It's a really big undertaking. And so even if you're able to buy it at $55 a foot, your basis is going to be $450 a foot. You're hoping you can get $4 rents, which is $48 net, less $10 in expenses. You're getting $38 net, and you've got $450 to $500 into it. That's kind of the math that people are going through, and why you don't see more conversions of these office buildings. I think the realistic outcome is what you have is probably 25 to 40% of the office stock has been underinvested, right? That owners have not kept track or kept up with what companies and ultimately their employees want. So if you think back when I first got in this business, it was 2012. No, I'm teasing. It was in the 90s. Tenants would move for 25 cents a foot. Right? They would relocate across the street to save 25 cents a foot. Today, tenants will go across the street and they'll pay double what they're paying to get the right set of amenities and environment and culture that they need to attract and retain the type of employees that they want to attract and retain. So HR now runs the real estate decision. Real estate doesn't run the real estate decision. HR does, because recruitment and retention is the most important thing. And so if you use that lens, and I've got an 80s style vintage building, what do I have to do for an HR person to say, yes, this is where we can build our culture. This is where we can get people to be excited about coming into. Brad hit on it earlier. The easy ones are walkable to concentrated retail. New buildings, walkable to concentrated retail. Those are the layups. But that's a really small percentage of the office building population. And so what do you do with a suburban 12-story asset built in 1984, right? Well, you can look at conversion. Most likely doesn't pencil based upon where you can sign rents. But I think it really comes down to, I've got to put in $20 a foot, $25 a foot into cosmetic base building stuff to change the appeal of my asset to the marketplace. And frankly, if I've owned this building for 10 years, I'm unwilling to do it. And so it almost takes a sale in order to get somebody in there that says, yeah, I'll be your Huckleberry. I'll do that and make it happen.
Yeah, you got to clear the assets almost at land value or inside of land value. And that's what we're going to see happen in a lot of West Coast cities because you're basically scraping it. And so you ask what some of these buildings are worth. The really older buildings, the 80s vintage, they're worth land value minus demolition costs. That's the truth. You have to have conviction to come in and invest. And that probably leads to our next topic is how are we going to get investors to have conviction in our CBDs on the West Coast?
And before you go there, Brad, just one quick question for you. you're on the West Coast, a lot of high profile layoffs being announced.
Always.
Doesn't seem to be an end in sight. You know, we're in this era where unemployment's just, it's so low. And Brad, you said, or Russ, you said that HR is driving the bus when it comes to real estate choices. But are you still seeing that on the West Coast, Brad?
Yeah, we haven't bottomed yet. We're still seeing companies dump space, and just saw Pinterest dump 150,000 feet. I mean, we've got, we're very heavy tech. San Francisco always reinvents itself, and I never count out San Francisco, because there'll be something that comes, whether it's AI or whatever. And VCs will pump a bunch of monies into these companies, and they'll start taking space again. It always reinvents itself, just like the gold rush. But right now, we're in a position where companies are scared. They're dumping space. They're laying off people. They're cutting costs. It's a risk-off atmosphere, and it's going to be that way, I think, until at least another 6 to 12 months before we really bottom out.
It gets back down to, if there's going to be a recession, when is it? How long does it last? How deep is it? And I think tech has consistently shown the ability to look around the corner, see what's coming next, and get positioned for it. They were hiring before anybody else did when things were recovering, and now they're laying off before anybody else is, because what they see. And a lot of theirs is being forced on them by VCs and their capital, saying, you're not getting any more money, so stop spending more than you bring in.
Sounds
Try
like
to
my
tell
house.
that to my wife. And
Yeah, it sounds like my house.
So, Brad, you were going to start talking about what is it going to take to give investors conviction.
The obvious is tax incentives, right? I mean, that's what everybody's talking about. London Breed's talking about it here in San Francisco, and we had one. I want to say 8 years ago for these called the Twitter tax break to kind of reinvent Market Street in downtown San Francisco, and it worked. Twitter went down there. A bunch of companies followed. Uber grew, and they were getting a pretty big tax break. And I think we're going to have to go back to that, because, I just don't think there's enough capital out there that's willing to make the bet yet. It might come but values have to drop. And then, you should have a green light and a fast track. If you're going to take an office building to resi, you shouldn't be held up by the city for years to get your entitlements. That should be fast tracked, boom, because you're carrying that. You have to. I mean, that's dead money until you can get that thing built. So I think you're going to see that. I think it's coming. I think the pendulum kind of went maybe a little too far left in some of our cities, and now it's kind of maybe coming back. Hopefully, a little back to reality.
And I might throw on there that I love the age-old analogy of greed versus fear, and that's what drives people's investment decision. When they're afraid, then they don't do anything. When they feel like they're missing out on opportunities, then they jump in. And I think the current environment that we're in 2023 is very much an entrepreneur's market. It's not an institutional investor's market, because they can be second guessed for mistakes they make. Entrepreneurs, they know they're going to make some mistakes, but the reward is worth it for them. And so I look at this as very much one of the better entrepreneurs environment, on par with late 80s, early 90s, in 2009, when there was nobody in the marketplace. Even though, the market bottomed, what was it, March of 2009? It was 2011, 2012 before you saw institutions come back into the market. And prior to that, and almost everybody in this business will say the same thing, I wish I'd have bought everything that crossed my desk, because I would have made money. And so look at this environment as maybe like we're in 2009, similar to the GFC, in that you're uncertain as to what is going to be next, but that doesn't mean you can't pick the right asset and get the right price. What it means is there may be some operational struggles in the short term, but I mean, once the bottom is passed and the institutions see it, it's too late.
It's too late. Yeah, right now it's a really high net worth kind of a family office environment where groups don't have an investment committee. They don't have to sit around with 6 or 8 people and convince them why they should buy this office building when they have 15 problems already in their office portfolio. So until the noise goes away, I think these investment committees, I think they're going to be very hesitant to step up to the plate. Whereas a family office is usually 1 or 2, family members that just say, let's go for it. I love this basis. We love San Francisco. We know it's going to come back. We got lots of time to be wrong. We don't need to finance until rates come back down. So let's go. And so you're starting to see that for sure.
So how long do you think it takes before the noise goes away, Brad, as you describe it? Because I remember the
I
great
wish it was
financial crisis
tomorrow.
painfully. Yeah, I mean, it took years for things to wash out and growth to start.
I think it's 6 to 12 months. And
That fast.
I do, because we've never seen interest rates go up this fast. So groups have to make a decision. When LIBOR is at 50 bips or 25 bips, you can kick the can down the road and you can pretend there's no problem for a long time because you're floating rate, it's free money. But when money gets as expensive as it is today, you got to make a decision.
And I really think for institutions, we're looking at 2 years, 3 years before they're going to come back and make a bet on office. So I think the entrepreneurs have a little bit of runway, but I also think some of the better buys are going to be the ones that happen this year.
Yeah, on the way down. You can't time the bottom. It's just like the stock market.
Yeah.
It's too late once you're at the bottom. You got to have conviction today. It's challenging, no doubt about it.
So there is opportunity out there for the savvy investor that's patient, well capitalized. There's opportunities, but you really need a few things to come together for you to make it work.
Fine.
Right?
You know what? I think sometimes it's a stock picker's market. This is an asset picker's market, right?
Mm-hmm.
You should never take a chance right now on location or quality or age. Define what it is exactly you're looking for. And it's kind of easy to define because those are the buildings that are the best leased, right? So that's one of the hard things is that the assets that are going to be the lowest risk are also going to be the highest price because they're the best leased. But then again, I think another way of saying what we see right now is that cash flow is on sale because there's so few bidders for it that you can get a bargain. Let's say, high quality asset that's 87% leased with 5 years of WALT. You can buy it at an 8 cap or an 8.5 cap. I mean, cash flow is on sale. So
and that cap rate, not to interrupt you, and that cap rate was what 2 years ago? Half, 4.5.
Well, in downtown San Francisco, yeah, but out in the hinterlands, that was probably a 6.5, 6.5. So a pretty significant. And yes, the cost of money has gone up. Yes, I agree with all that stuff. But I would also say you're probably picking assets in higher growth markets. You're not picking assets in suburban Chicago where you're having a lot of flight of companies and employees. You're focused on where the growth is going to take place, where you think it's going to, and once again, just be very specific and be really thoughtful. What kind of asset do I want, and just make sure you buy those. And I just think you take care of a lot of your risk. If you have an asset that tenants want, that's not nearly as bad as just buying a generic option on office buildings. Naturally, or by market.
Sure. But even for that transaction, you're going to need some sort of adjustment, probably, I would think, on the seller's part as to what it's worth, because you can't get the level of debt that you used to be able to get 2 years ago, and you're certainly not going to get the same interest rate.
That is the market, right? The sellers, if they're going to trade, they've got to meet the market, and you're not competing with the world's largest pension funds. You're competing against somebody like you, but maybe they need debt. You don't need debt. There's different ways to compete, but everybody's dealing with the same metrics.
Okay.
And by the way, I used to underwrite. It's just on an unlevered IRR basis. Our unlevered IRRs were anywhere from 6 to 8%. Today we're underwriting to 15 to 18%.
Wow.
Unlevered. That's without leverage. So if you were able to get leverage in a year, now you're talking about a 30 plus levered IRR. So
that family office that's willing to plop down all cash, that's a pretty good
return. It's a good return just by itself without leverage. It's a good return.
So last question for you guys. This has been a really fascinating conversation. I really appreciate it. We've had some high profile borrowers, and we won't name names, but there have been some high profile borrowers who have handed the keys back, right? They've walked away from loans, from CMBS loans. Are those one-offs? Do you think that is going to be a problem of the great financial crisis scale? Do you think it's systemic, or do you think it's going to be painful for a few players, and it's going to wash itself out.
So you're reading the headlines, and the headlines is so-and-so defaults, so-and-so defaults. There hasn't been a lot of handing the keys back, because that's a negotiation tactic. If you're one of the bigger firms, that's a way to work out your loan. And CMBS lenders, that's a whole nother conversation. They're very hard to do loan workouts. So a lot of what you have to do is just stop paying. And then they come to the table. You have to get transferred from master to special. And it's a whole process, and it's slow and it's painful. So a lot of that's a negotiation tactic that you're reading. You will see big groups hand keys back because they have to be a fiduciary for their capital. And if they think they bought a building 2 years ago and it was $800 a foot, now it's worth $400 a foot, what are they supposed to do? You can't save everybody. So they're going to look in their portfolio and say, let's save this one, this one, this one. That one doesn't have a chance for whatever reason. So you are going to see it, but a lot of what I see going on right now is more tactical and strategic than anything else.
And if it was worth 800 and now it's worth 4,
lender, we both have.
Somebody probably gave you 700 for it, right?
Yeah,
so it's still someone's problem.
We have a problem, right? It's not
right. Okay.
So let's both come to the table and figure out a solution. And a lot of that's, writing the loan down, having fresh capital come in. I'll put in new capital. You write my basis down. Think it's going to get really creative, and it always does. The lawyers are going to make a lot of money.
They always do.
Yeah. I definitely see quite a bit of these transactions coming. Most likely, you'll start to see more of it or see it accelerate in the second half of the year. But is it on terms of the GFC? Yeah, I'm not sure. Because so much of it was assets bought in 2018, 2019.
Okay.
That assets bought before then, there was enough rent growth inherent in their rent roll that they'll be able to figure a way out. So it's not pervasive across the entire landscape. It's going to be more isolated.
Yeah, asset specific, lender specific, asset specific, and market specific.
Russ, Brad, CBRE, thank you so much for your time. I wish you the best of luck out there over the next year. Hopefully this creates some great opportunities for you guys as well. I really appreciate the time.
Thank you.
Thank you, Ed.
So you might be wondering, why are we talking about office space today? Well, it's part of a bigger picture because the Federal Reserve has been saying for about a year now that they want less liquidity in the economy. They want tighter monetary policy to bring down inflation. And look, that all sounds nice and neat and tidy. And there's been talk of a soft landing while this all plays out. But what the Fed is going to do is actually raise interest rates until things start to break. They want to get to the point where banks stop a lot of their lending. That's less liquidity, and that means the economy slows down, probably turning the economy into a recession. That's what the Fed hopes will bring down inflation. And I would argue that their actions are going to cause more than a couple of banks to fail before this is all said and done. And the chance of a soft landing just gets lower and lower every week. That's why we're talking about office loans. And it's why we're going to soon dig into auto loans and the other challenges facing the banking sector and the economy. As you heard, what is a crisis for one party is a great opportunity for another. And with these videos, I'm hoping to make sure that you and I are on the right side of that scenario. So take a minute to subscribe to our channel and sign up for our weekly Global Macro Update letter by following the link in the description below. I'm Ed D'Agostino. Thanks for watching.